Bloomberg On the Economy with Tom Keene, Friday, March 5th, 2010.
I'm McKee, filling in for Tom Keene in New York. And what a day it is. Too bad Tom missed it because he would have loved this. Everybody went into today thinking we were going to see a big drop in the employment numbers, the payroll figures, because of the snowstorms in February. And of course, we certainly haven't recovered completely in the labor markets from the recession. Instead, we lost only 36,000 jobs on the month, and we saw the unemployment rate hold steady at 9.7%. It was supposed to rise. What happened? Dean Maki is chief U.S. economist at Barclays. He's joining us now. Dean, welcome to the program. Were you as surprised as most people were when the number crossed the tape?
We were surprised. We were looking for a 75,000 drop, and what was surprising is that we clearly see the weather effects in the data, but what the message we're taking away is that the labor market is actually stronger than we had anticipated going into this number.
When you put your figures together, of course, you look at each category and how many jobs they might have contributed, and then you had to pick a number out of the air in terms of the snowstorm effect. What did you think the snowstorms would have subtracted, and why did you think that?
We were looking for about 125,000 negative effect on February employment from the snowstorms. And I don't think that's still, after looking at the data, I think there was somewhere in that range of an effect. We believe that employment would have grown significantly in February absent the snowstorms.
Now, one reason it didn't grow significantly besides snowstorms was there was almost no census hiring. Also a surprise there?
That's right. We were wondering whether the census would be able to complete the hiring it had planned given the snowstorms that hit the D.C. area during the survey week, and it does appear they weren't able to hire as much as planned. So looking ahead to March, we do think there's going to be a substantial bounce both in terms of overall employment as well as in census hiring.
In this case, normally when you see a big drop, you see a rebound if it's an exogenous event. We didn't have that event. So why do you see a big rebound? Could we just sort of be moving along a trend here?
I don't think that's the right message. And the reason is that the weather clearly depressed the reading. So it's a little bit deceptive in the sense that it looks a lot like last month, so nothing seems to have happened. But what we believe happened is that there was a significant improvement. Weather eliminated that improvement from the data.
Well, you certainly see an improvement in the household survey. We saw 308,000 people hired, and the jobless rate stays at 9.7%. How weird was this, Dean? 9.687% to three digits, the exact same as January.
That is unusual that they would round to the even unrounded be the same number. What the message here is that the unemployment rate is on a downtrend. We believe it peaked in October at 10.1%. We're expecting it to fall to 9% by the end of this year, and these numbers are well in line with that kind of a forecast.
Which raises the question then of what does the Federal Reserve make of all this? They were prepared. A number of Fed officials told us over the past 2 weeks they're not really going to pay much attention to the jobs report because of the snow distortions. They were prepared to ignore it. And now they have a meeting coming up in a week, and they have to decide what to do, at least about their language. Does this lead them to change or to consider changing it, the fact that we may have seen unemployment peaked and now we've been down for a couple of months and the labor market seems to be getting better?
We're not expecting a change in the language. In particular, we expect them to leave the extended period language in place at this meeting. They'll want to see some stronger numbers, some real job growth before they're willing to tweak that language.
Well, what in this report suggests to you that we're going to see stronger job growth?
When you combine the message of the household survey, which, as you mentioned, that already is showing significant job growth, with the fact that construction was weak at minus 64,000, the census hiring that we talked about earlier, we think that those sectors in particular are going to be much less affected by weather in March in terms of construction, retail, manufacturing. And we do see those sectors bouncing from where they are now.
All this market reaction, Dean, of course, due to the fact that the numbers are better than expected. How long should the enthusiasm last? Is this sustainable?
Well, when you look at the broad array of economic data, this better than expected number fits in quite well. The ISM surveys look quite good in February. The manufacturing survey was the second highest reading in 5 years. The non-manufacturing rose to the highest level in a couple of years. So when you look at the broad perspective, the economic data in the U.S. are improving notably, and this report fits in with that pattern.
And that's likely to continue, you think, or does that start to fade out as the stimulus money starts to fade, as inventory rebuilds start to flatten out? A lot of predictions that we're going to see much slower growth going into the second half of the year.
And we don't see it that way. Certainly, we're not going to continue at the 5.9% pace we had in Q4. There were some special factors boosting that number, but we're expecting 3.5% to 4% growth throughout this year. So we don't see a drop-off in the second half.
One of the interesting numbers in here, manufacturing, we saw 1,000 jobs gain, which may have been held down by the weather. But it's only the second month in the last 3 years that we have seen job growth in manufacturing. Is that a trend that's going to continue, or is this a little bit of a bounce back because of the inventory rebuilding and the general trend in manufacturing of job losses is going to resume?
I think it's reasonable to see modest job gains in manufacturing this year, to expect to see that. Manufacturing is in a pretty powerful upturn, and we do expect that to continue. But still, it's worth highlighting the majority of jobs are going to be created in the service sector. And we did see now in 3 of the past 4 months, the service sector has added jobs with a 42,000 job gain in February.
What is the future for manufacturing, though, beyond this year? Are we going to continue to see declines as productivity makes us much more of an automated manufacturing society?
It's a safe bet that manufacturing will continue to lose share as a percent of total employment. That's been a trend that's been in place for the last 50 years. I don't see any reason why it wouldn't continue in coming years. It has a lot to do with what you mentioned, which is that productivity is just a lot faster in that sector, so we can make more and more things each year with fewer people.
How fast then does the service shift continue and we start to pick up service-related jobs? At this point, with sales slow, are we still likely to see slow hiring in, say, retail?
One thing that we believe is that the corporate sector as a whole, including the service sector, overreacted to the downturn. And that means they cut employment far more than the actual drop in output would have suggested. So we think they are going to have to hire to make up for some of those job losses that, as it turned out, were not necessary.
How much and how soon?
We believe that by around the middle of the year, we're going to be adding something like 200,000 jobs per month. So it is going to be a substantial pickup in hiring, in our view.
And that should start to finally bring down unemployment on a meaningful basis.
That's right. We do think that when you're creating jobs at that kind of a pace, the unemployment rate will be on a steady downtrend all year.
The Senate and House have been working on jobs creation bills, additional stimulus. Are they still needed?
Well, it depends what one's preferences are. I think that the economy certainly is going to continue to recover this year, and the unemployment rate will be falling, even absent additional jobs bills. So while those bills may help a bit on the margin, they're not going to be the main story of why the unemployment rate falls.
Are they worth the money? Is there enough that you can do to create jobs through stimulus at this point, given people's worries about the deficit?
I I don't think it's reasonable that stimulus will be the main way that we create jobs. So I am skeptical of any massive jobs program at this point. I think the economy is on the right track here. It's just going to take some time for that unemployment rate to fall. I realize that's not necessarily a popular view in Washington, but I think that's the reality that we face.
Well, on the other hand, you're not running for election this
Exactly.
year. Now, the interesting thing about the unemployment rate, again, not only that it held in place and the three-digit rounding was exactly the same, but that it held in place with a rise in the labor force of 342,000 people. Indeed, and of course, economic history would teach us that when the labor force rises coming out of recession, unemployment rises, and that's one of the reasons it's a lagging indicator.
That has happened in some recoveries in the past. However, when we look back at the majority of recoveries, there really isn't a surge in the participation rate. And we don't expect that this time either. A lot of the baby boomers are moving into the retirement years, and many of them won't come back into the labor market. So we're not expecting any big surge in the participation rate, and therefore we do think it's going to be a relatively steady move down in the unemployment rate.
Well, that's interesting you say that, because a lot of people are saying, we have so much ground to make up because so many jobs were lost during the recession. And you look at the U6 unemployment report, which a lot of people say is the most interesting because it includes discouraged workers and those who are working part-time because they can't find jobs. 16.8%, that actually rose. But you have a different view that the labor force is going to be smaller going forward. We may not have to make up as many jobs.
We do think the trend rate of job growth has lessened, the pace that's needed to keep the unemployment rate steady. I would put that somewhere in the 75 to 100,000 range. It's gone down a lot from a couple of years ago, and it has a lot to do with the aging of the population, and that means the labor force is just going to grow a lot slower.
Dean, this gets us back to the Fed's reaction. How far out are you on them at this point? Dean Maki, who is chief U.S. economist at Barclays, you say they're not going to react at this meeting. Which meeting might they start to if this trend continues?
I think at either the April or June meeting, it's reasonable to expect them to change that language. That language is typically interpreted as being roughly 6 months. And I don't think by the end of the second quarter that the Fed will be comfortable saying it's going to be on hold all year. The job numbers, we believe, will be getting much better starting in March and moving through the second quarter. And in that kind of environment where the unemployment rate's on a steady downward trend, the Fed is unlikely to want to keep saying it's going to be on hold for an extended period. And so we would expect that language to be changing in the second quarter.
All right, we're at 3.68% right now, 3.6869 on the 10-year note, 2-year note, 0.9. When the language changes, how much of a reaction is it? Is this also a monetary policy tool, the language they're using now?
It certainly will induce a notable reaction. And because the message will be quite clear that you can't count on the Fed being on hold for 6 months anymore. And so that will get markets to shift pricing most likely if they haven't already shifted by that time. And we do see that as a major event.
And then when they do start raising rates 6 months after April, in the fall, is that really likely? Because that's election time. We were talking about that at the start of this conversation.
It certainly is. The September meeting is going to be tricky because it is, the last meeting before the election. Our view, though, is that the Fed ultimately does make policy decisions based on what's best for the economy, and it will generally look through political considerations and just do what it thinks that's right. For example, it's hard to imagine that 50 basis point Fed funds rate, for example, would be a major issue in the election.
But it could be in terms of the Democrats looking back. If they lose seats, George H.W. Bush always blamed the Fed for his loss in 1992. So there's a political calculation here, isn't there?
There is, but although I don't think the Fed will be making that political calculation, but I do think that one thing to remember is that the Fed will only be raising rates if the economy and the labor market are looking much better than they are now. And so in that environment, starting to normalize the funds rate really won't be able to be interpreted as hitting the economy hard.
We got about 30 seconds left. Let me ask you to close by defining what normalizing means. Where do they go with rates by the end of the year and by the end of the following year?
We're looking for rates, a Fed funds rate of 1% at the end of this year, 2% at the end of next year. So a very gradual pace of hiking.
And there was a time when we would have thought that was a very low interest rate.
Those are very low numbers, and the Fed is going to have easy policy for quite some time.
All right. Thank you very much, Dean Maki, for joining us today. I'm Michael McKee, subbing in for Tom Keene. He missed the big jobs report, 36,000 jobs lost, but we expected 68,000. The jobless rate stays at 9.7%, which also was a surprise. So there's going to be lots to talk about on the economy when Tom gets back, hopefully next week. You're listening to Bloomberg on the Economy on Bloomberg Radio.
Listen to Bloomberg on the Economy weekdays at 11 a.m. and 7 p.m. Eastern on Bloomberg 1130 in New York, or on satellite radio, Sirius Channel 130 and XM Channel 129. There's more radio and television news on the Bloomberg terminal at AV Go and at Bloomberg.com. Stream it live. Download to your iPod or desktop. Copyright 2010.